Hi, this is Peter Schaeffing of High Impact Financial Analysis. So this is the first of what I hope will be a daily series of high impact moments or something. We'll come up with a snappy name for them. But basically, I wanted a way to get a little information out to the CDFI industry and the impact lending industry without sitting down and writing a blog or composing a LinkedIn post. This is something I can bang out in 30 seconds or a minute that I hope will add some value. So the thought I want to start with today is on the charter school industry. So we work a lot with lenders who are active in the charter school facility market, and we've seen a real slowdown in transactions this year, and we've been told anecdotally that organizations are finding it harder to get money out the door for charter schools, and we've just seen it. There's fewer deals coming across our desk in that space. So a big reason why, and I think this is not news to the industry, is that there are new sources of capital. The Equitable Facilities Fund, which was the former Charter Impact Fund, has a very large investment from Walton that they're putting out. We see organizations like Civic Builders that used to just be a charter school facility developer that is now lending to schools. So there's this huge infusion of capital, not to mention REITs and other private equity, that's really making it harder for a lot of CDFIs to compete. Low rates, long terms, very difficult kind of product for a CDFI to meet. So we're seeing a case where the CDFI industry is effectively doing what it often says it wants to do, which is making itself obsolete in a way. You know, we want people to become bankable after we work with them. We want an industry to become bankable. And the charter school industry now is pretty mature. It's able to access capital that would have been that it would have been too risky to attract years ago. So I have two thoughts on how the CDFI industry can and should adapt to this. One is to get more, transition some of that staff and that industry knowledge in the charter school space and pivot down to the early care space. Ton of research about the importance of quality early education, and there's a lot of private facilities and other facilities that need capital to get off the ground. And then for charter school lenders or impact lenders to stay in the charter school space, I think it's going to be important to get a little creative. I think offering a pre-development loan product to charter schools makes some sense, or to charter school organizations supporting charter schools, like Friends of organizations. That would be a way to put out some higher risk capital that then might also give you the relationship to go ahead and get the long-term deal that you might be, a little higher priced for, or to look at other products like working capital, where there's no real estate collateral involved at all. That's kind of the higher risk product now that maybe the general lending industry can't accept, that perhaps CDFIs can get comfortable with. So I'd love to hear your thoughts. What do you think? Are you seeing fewer deals? Is it an issue of tenure and interest rate, or is there something else at play here? Or are you seeing plenty of deals and you don't know what a problem is? Let us know. Let me know what you think and how your CDFI might be positioning itself to work after this big change in the capital availability for charter schools. Thanks.